If you think what happens in Tokyo stays in Tokyo, you might want to keep listening. Because when the world's largest foreign holder of US government debt shifts direction, that's not a local story. That's a structural one. And structural stories don't trend on social media. They quietly reprice everything. Japan has entered a new political chapter. A powerful electoral mandate, a bold fiscal agenda, and a clear willingness to stimulate growth after decades of economic stagnation. On the surface, that sounds domestic. More spending, tax relief, a push to energize consumers and businesses. But global capital doesn't recognize borders the way headlines do. For more than 30 years, Japan operated in a near-zero interest rate world. That created one of the most important forces in modern finance, the yen carry trade. Japanese institutions could borrow money at extremely low rates, convert it into dollars, and invest in higher-yielding US assets, treasuries, corporate bonds, equities, even real estate. The math worked beautifully when Japan's rates were anchored near zero and US yields were meaningfully higher. That flow of capital wasn't a side note. It became part of the plumbing of global markets. Now that plumbing is being tested, Japanese government bond yields have risen to levels not seen in decades. The Bank of Japan has gradually stepped away from its ultra-loose policies. And while rates in Japan are still low compared to historical global standards, the direction of travel matters more than the absolute number. Here's why. Carry trades don't unwind slowly when the economics shift. They tend to reverse when the spread narrows enough to reduce the reward relative to the currency and interest rate risk. If borrowing costs in yen rise while US yields drift lower, that once comfortable cushion shrinks. At some point, for some investors, it may no longer justify the exposure. When that happens, money doesn't vanish. It goes home. If Japanese investors begin reallocating more capital domestically, whether because local yields are more attractive, currency risk is less appealing, or policy incentives favor domestic deployment, that could mean fewer marginal buyers of US bonds. And in bond markets, marginal buyers set prices. More supply without equivalent demand typically pressures prices. Bond prices and yields move in opposite directions. If yields rise, borrowing costs across the US economy can follow. Mortgages, corporate debt, government financing, all of it is interconnected. Now layer on fiscal policy. Japan holds substantial foreign reserves, much of it in US dollar-denominated assets. If a government facing ambitious domestic spending goals looks at those reserves as a potential funding source, even partially, that conversation alone can shift expectations in global markets. It doesn't require dramatic liquidation to move prices. Sometimes it only requires the possibility. We've seen glimpses of this dynamic before. In past episodes where the yen strengthened sharply or Japanese rates moved unexpectedly, global risk assets reacted. Volatility spiked. Investors were reminded that leverage tied to currency spreads can unwind faster than most anticipate. None of this guarantees a crisis. Markets are adaptive. US Treasuries remain among the most liquid and widely held assets in the world. Demand comes from pensions, insurers, central banks, and private investors across continents. But the balance of flows matters, especially at the margins. The bigger story isn't about one election or one policy package. It's about a subtle shift in a decades-old equilibrium. For years, Japan exported capital in search of yield. If even part of that capital finds a more compelling reason to stay home, global asset pricing adjusts. That adjustment could be gradual, it could be uneven, it could show up first in currency markets, then in bonds, then ripple outward into equities, or it may settle quietly into a new normal, where investors demand slightly higher compensation for holding long-duration US assets. What's often overlooked is that global markets are less about dramatic announcements and more about incentives. Change the incentive structure, and capital eventually follows. So while headlines may frame this as a domestic political moment, the deeper question is whether we're watching the early stages of a multi-year rebalancing in global capital flows. If so, the implications extend far beyond Tokyo, into portfolios, pension funds, and borrowing costs around the world. and the markets rarely send engraved invitations before they adjust. There's a moment in every cycle when a trade that looked effortless starts to feel heavy. Not because it stopped working overnight, but because the math quietly changed. For years, borrowing in yen and investing in higher-yielding US assets felt like financial gravity in reverse. Japanese rates hovered near zero, US yields were meaningfully higher, and the spread did the hard work. Institutions could fund cheaply in Japan, deploy capital into treasuries, equities, credit, even property abroad, and collect the difference. It became so common it stopped feeling like a strategy and started feeling like infrastructure. But spreads compress, and currencies move. When Japanese yields rise while US yields soften, that once comfortable cushion narrows. Add in currency risk, because if the yen strengthens while you're holding dollar assets, the conversion back home can erase gains, and suddenly the easy trade requires conviction. What was once incremental income starts to look like asymmetric risk. We've seen how sensitive this system can be. In a prior episode, when the Bank of Japan merely signaled the possibility of policy normalization, global markets reacted quickly. US equities wobbled, volatility surged, and leverage positions were forced to unwind. It wasn't a collapse of fundamentals. It was the mechanical effect of capital moving at scale. When funding conditions shift, flows adjust. And flows, more than headlines, move prices. Now layer in politics. Japan's current leadership holds an unusually strong mandate. With that comes the ability to pursue expansive fiscal policy, larger budgets, targeted stimulus, tax adjustments aimed at reviving domestic growth. After decades of deflationary pressure and economic stagnation, that ambition isn't surprising. What matters is how it's financed and how markets interpret it. If fiscal expansion coincides with gradually rising domestic yields, Japanese institutions may find more opportunity at home. Pension funds, insurers, and banks constantly evaluate relative value. If local government bonds begin offering yields that are no longer negligible, and currency volatility adds uncertainty to overseas investments, the incentive structure subtly shifts. It doesn't require a dramatic liquidation of foreign reserves to matter. Even a slowdown in incremental buying of US treasuries could influence pricing at the margin. Bond markets are enormous, but they are also sensitive to changes in demand from large, consistent participants. When marginal demand softens, yields may need to adjust higher to attract new buyers, and higher yields ripple outward. Mortgage rates, corporate borrowing costs, equity valuations, all are, to some degree, anchored to the risk-free rate. Growth sectors, particularly those reliant on cheap capital, tend to feel that pressure first. Commercial real estate, highly leveraged companies, long-duration assets. These areas are especially sensitive to changes in financing conditions. There's also a currency dimension that deserves attention. Expansive fiscal policy combined with accommodative monetary conditions can, in some cases, weigh on a currency. If multiple major economies pursue similar strategies simultaneously, foreign exchange markets can become volatile. Competitive devaluations aren't official policy in most developed nations, but relative rate differentials and liquidity conditions effectively create currency competition. In that environment, investors often reassess what truly preserves purchasing power. Historically, during periods of synchronized monetary expansion or fiscal strain, capital has rotated toward assets perceived as scarce or less sensitive to policy decisions. That doesn't guarantee a specific outcome, but it explains why conversations around commodities, precious metals, and companies with strong balance sheets tend to resurface during these transitions. What makes this moment different isn't a single policy announcement. It's the convergence of rising Japanese yields, shifting fiscal priorities, evolving US rate expectations, and the enormous stock of capital that has been positioned for the opposite environment. When positioning becomes crowded, even modest changes in assumptions can trigger outsized moves. None of this ensures turmoil. Markets adapt, capital reallocates, new equilibria form. But transitions can be volatile, especially when they unwind trades that have been in place for decades. The real edge isn't predicting a crash or a boom. It's understanding the mechanics beneath the surface, the funding costs, the currency exposures, the marginal buyer in the bond auction. When you understand the plumbing, volatility looks less like chaos and more like cause and effect. And in a world where capital can cross borders in milliseconds, what happens in Tokyo may not stay there for long.